Welcome, day traders. Risk appetite on the Asian stock exchanges is declining today. The US benchmark stock indexes retreated yesterday, and the US dollar immediately took advantage of it. Meanwhile, the yen notched the longest losing streak in 50 years. Watch our video review and find out more interesting details. Let's start. The US stock indexes fell on a Wednesday after two consecutive sessions of growth. It seems that optimism fueled by strong earnings reports has waned eventually. Strong quarterly reports were the main driver that pushed US stocks higher at the start of the week, and the Fed's aggressive tightening has again undermined an upward reversal in the equity market. Yesterday, the Beige Book was published. It means that FOMC meeting will take place in less than 2 weeks. The regulator is expected to raise the key rate by 75 basis points for the fourth time in a row at its November meeting. Apart from that, Fed policymakers made new hawkish statements. St. Louis Fed President James Bullard believes that the interest rate could be raised by 75 basis points in November and December. Chicago Fed President Charles Evans said that the Fed should push the cash rate to the target range and then make decisions based on incoming data. Minneapolis Fed President Neil Kashkari once again warned that the consequences of a slow monetary tightening would be more devastating than those of an ultra-hawkish stance. As long as the Fed sticks to monetary tightening, market uncertainty and the risk of a recession will persist. In the Asia-Pacific region, things may be even worse, as there could be further capital outflow from the Asian markets. US government bonds are one of the most reliable safe haven assets in turbulent times. After yesterday's stock market decrease, the 10-year note yields jumped above 4%. The 2-year note yield, which is very sensitive to the Fed's monetary policy decisions, reached a 15-year high of 4.59%. The US dollar also moved up after the US Treasuries approached multi-year highs. In the morning, the greenback was rising across the board. It climbed overnight by 1% or above 113 points. The US dollar index also regained momentum as a safe haven currency. In the Asian session, it slightly retreated, entering the sideways channel of 112.71 and 113.09. Usually, the US dollar slides into the consolidation phase before the FOMC meeting. Perhaps now we are witnessing a similar situation. It's trading at 112.86. However, it's clear that its decline is unlikely to last long. While the US dollar is gathering strength for a new rally and the US government bond are on their way to new multi-year highs, the yen looked another anti-record. The dollar-yen pair hit a 32-year low. Traders were looking for any signs of intervention, and the Bank of Japan intervened. However, it had nothing to do with the yen. The fact is that the 10-year Japanese government bond yield exceeded the 0.25% upper limit. The regulator ramped up bond buying to knock the yen back to its 0.25% cap. So the Bank of Japan was forced to product its first unplanned bond purchase in October. The continuing depreciation of the national currency for 11 consecutive sessions and the Bank of Japan's chaotic auctions have undermined confidence in the regulator. On top of that, the Minister of Finance said that the country posted the largest trade deficit on a record for the first half of the fiscal year. One of the analysts made a joke that the fragile yen looks like a rabbit caught in the headlights. It has dropped for 11 consecutive sessions, logging the longest losing streak since 1973, and today it also keeps falling. The yen has almost approached the psychologically important level of 150 yen per dollar. In the Asian session, it was trading near 149.93. The watchdog is facing a real challenge now, especially given the growing divergence between the monetary policies of Japan and the United States. Prime Minister Fumio Kishida pointed out that Japan's economy faces risks from overseas developments. However, this statement can hardly be called an interlude before intervention. This is why the dollar-yen pair is climbing higher, moving in the price corridor of 149.62 and 150.09. The Australian dollar lost steam because of a downbeat macro stats. Australia revealed its labour market report today. The unemployment rate in September remained unchanged compared to the previous months, which was in tune with a forecast reading of 3.5%. For the Reserve Bank of Australia, it's a signal to stick to its less hawkish stance or even cut rates in the future. This is rather bearish for the Aussie. If so, it will definitely drop considerably against the US dollar, given the risk aversion, weak demand for Australian goods in China, and unstable commodity prices. The Australian dollar could sink to the lowest level in the last 2.5 years. However, it may also regain ground amid the consolidation of the US dollar. In the Asian session, the Aussie was moving in the upward range of 0.6229 and 0.6280. Now it's trading at 0.6270. And that's all for now. Subscribe to our channel and have the latest market news at your fingertips. Feel free to leave your feedback down below and see you soon.